Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com.
Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And today we've got a semi-regular former host of Golden Rule Radio with us. Eric is back in the studio today.
Yeah, sometimes when you're at the printer by the studio, right around 2:30, you get grabbed and brought into the studio.
Right,
so.
when Robert's out of the office.
That's right. Yeah.
Robert's out of the office due to the snowstorm. And Eric, you were just in the right place at the right time.
Or wrong place at the wrong time.
Depends on how you look at it.
Regardless.
But because it's been a while, we're going to make you start the show out today, Eric. So what's going on in the metals market?
You bet. A lot of volatility in the broader markets today, as I don't need to touch on the fact that the Federal Reserve had their last meeting of the year today and addressed rate hikes for next year. I'll let you guys get into that, but through that, we had some major price swings. If you're a swing trader, today was a very busy day for you. Low on gold of $17.55. As Jay Powell spoke, and the markets rallied hard off of all of their support. As we sit here now at about 3 o'clock Mountain Time, gold's at $17.80, silver at $22.16, which also had an intraday low of $21.42. So massive moves today on the Federal Reserve speaking. Platinum, which fell sharply again this morning with the broader markets, low of $8.89, currently trading at $9.20 an ounce. And Palladium, who I didn't really look at today, but we have been discussing over the past few days, just due to the massive disparity between the bid and the ask price. That traded at a low of $14.74 today and is currently trading at $15.75.
Wow. I hope you all have your seatbelts on if you own Palladium. That's not just huge intraday volatility. That is huge intraday volatility over the last couple of weeks, just losing its strong position coming down over 1,000. We'll get into Palladium in a little bit, but Miles, this is all indicative of what we've been talking about here lately too, just this constant tug of war going on with prices. And today's a perfect example of what you're always saying, and that is news moves the markets. It's just a matter of where does it go, what technical support and resistance numbers. Today, news obviously moved the markets, as it seems to every day, but certainly on a grander scale today. So let's start with gold. You want to dig in deep and show us the images?
Sure, and I think both the precious metals and the Dow, also the Dow being up following Powell's announcements today, is a perfect example of that sell the rumor, buy the news. It's buy the rumor, sell the news when you're expecting it to be dovish communication. And in this case, I think most of the market expected a fairly hawkish conversation from Powell, as has been the case for the last couple Fed meetings. He's been hinting at decreasing inflation. He's been hinting at raising interest rates. He's been hinting at these more hawkish approach to the markets. We've done the exact opposite. The message that's come out has been a desire to at least be more hawkish going forward. And that's exactly what we saw. We saw most of the markets going down over the last couple days, gold included. Looking at the gold chart, short term, dating back to the last time we hit down around 1680 back in July and August, we hit the 618 fib correction level today, and a very sharp candle back up. So as Tori was alluding to, one of my favorite sayings is that news doesn't move the markets. It simply speeds up or slows down the direction that the trend was going. In the short term, news has all the control, but in the long term, the trend reigns, and the trend right now, at least for the last year in gold, has been this sideways pennant pattern correction in the long-term rising gold bull market that started back in 2015. So short term, last couple days, gold's down, Dow's down, everything's been down in anticipation of a hawkish interest rate rising, inflation declining, better economy that we're all hoping for next year. So the anticipation pushed the pricing down. And then as soon as the announcement comes out, everybody does the exact opposite. So everything happened as expected with good old-fashioned efficient market hypothesis and the concept of buying the rumor, selling the news, or in this case, selling the rumor and buying the news.
The real issue here is just how far behind the curve the Fed really is. So you knew that this had to happen. They were sitting there speaking from the same microphone 6 months ago saying that inflation was really not an ongoing concern. It was transitory. And unfortunately, what's happened is, as always, the Federal Reserve is behind the curve on this deal. And so, Eric, we've been talking for weeks. They've got to do this. And I think Powell had to get through his nomination, first of all, his renomination.
Absolutely.
From President Biden, right? So political sensitivities and convenience rule the roost. But the Fed balance sheet is still $8.7 trillion, which is unbelievable. Yes, they're slowing down their bond buying. That's what they're doing. They're not stopping. They're hoping to stop.
Well, not only that, they doubled the amount at which they're going to decrease the bond buying. But my question there is, why are you still doing that when you're admitting that inflation is here? And what does that do to inflation moving forward?
Exactly. Okay, to that point, same thing with raising the debt ceiling. So they're going to throw more money at the problem, and that's the problem. We're watching it in Japan. The Bank of Japan is offering these huge cash injections to combat their rising short-term rates. So the answer to everything, it seems like, is throw more money at it. That's why the Federal Reserve balance sheet is so high. That's why the U.S. national debt is so high. And they are showing that they're not going to stop that. We now have, by a 50 to 49 Dem to GOP vote, the U.S. Senate voting to increase the nation's debt limit by $2.5 trillion. We knew that was coming. So bring on $31.4 trillion as if it doesn't mean anything. But here's an interesting fact. There's a thing called the Taylor Rule, and David and Kevin have spoken a lot about this on the McIlvaney Weekly Commentary. But the Taylor Rule actually shows right now that the Fed funds rate should be 9.25%, given the U.S. inflation and employment rates. So the Federal Reserve came out. Powell says they're going to raise rates at least 3 times in 2022, and the expectation now is for 2 to 2.15% in that federal funds rate. Now, that's going to slow down some market sectors, but the line that they're trying to walk on, a very thin line, a tightrope, if you will, is this unemployment and inflation line and not stagnating the economy too quickly. And yet they're still throwing money at the problem. You're right. Yeah, you're going to speed up the rate at which you reduce your spending. Like, even that is confusing.
Right.
So by throwing more money at the issue, you're going to inflate further. If they pass this Build Back Better program, that's going to inflate further. The Congressional Budget Office already showed that it's going to create $3 trillion additional debt dollars on top of what they're saying is already going to be paid for. So President Biden comes out today, admits that inflation's an issue, and yet says, because of that, Congress needs to pass a $2 trillion spending package.
Well, and I'm glad, Tori, that you bring up some of Powell's concerns, because they try to write these things off as not concerns, but then they point out that labor participation is down. They tried to write off inflation as not a concern. We're totally not worried about it, except it's higher risk than it was when we brought it up 6 months ago. We definitely would like to raise interest rates 3 times next year, but you can't do that, because now one of the mandates of the Federal Reserve Bank, for Lord knows what reason, has to do with unemployment. So how do you fight unemployment with the same tool when you're the Federal Reserve as you fight everything else with? And that's just printing and manipulating both the money supply and the interest rates. So do I think that the hawkish conversation is telling us what the future is going to look like? Absolutely not. I think they're telling us what they would like to do if they could, but then they're also annexing it with the reasons that they probably aren't going to be able to. They are concerned about labor participation and unemployment, and they are concerned about inflation, and they're starting to hint at the fact that they're concerned about it, which to me is a political way of saying they're probably losing sleep over it. I mean, it is a big deal. And let's not forget that in the corporate sector, the bulk of what's moving the equities market over the last number of months is corporate buyback programs. So there's no healthy participation in the market outside of manipulation, either from big business manipulating within their own stock portfolios, or from the Federal Reserve manipulating from their end in the monetary supply and interest rate system. So I'm genuinely concerned for what 2022 looks like.
Well, they are too, Miles. To me, again, it's going to be an election year. So you've got this political sensitivity issue and survivability. But this comes straight out of the release today. This is 2 o'clock Eastern. The Federal Reserve's ongoing purchases and holdings of securities will continue to foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. That's manipulation.
Boy, that sounds
Flat
hawkish.
manipulation, yeah. Pure blatant manipulation.
Yeah, that sounds like a white hawk you release at a wedding.
So what effect is that going to have, Eric, as we come into 2022, in your opinion? But thinking about what we see price-wise, will this have an immediate effect both on cost of goods as well as precious metals.
Yeah, I think we had the PPI number come in yesterday, hottest all time. Things are very expensive. It's palpable. We can all, whoever's listening, you can feel it, right? You can feel it in your own wallet that this inflation is here. I'm more concerned now that the Fed has admitted that inflation is here. What next? Do we try to hide the fact that stagflation is here? And more so, when do the markets care? Because as Miles alluded to, today was a little bit more hawkish. There was a hawkish tone. They're speeding up the taper. And if you looked at the cues this morning, all your high growth stocks were down sharply. But as soon as Jay Powell started talking, they rallied back very strong, including the emerging markets, which doesn't really have much logic to me when we're admitting that inflation is here, right? Inflation is here, and those are the areas that should be hit the hardest. But they defy all logic again and rally hard today, which to me seems like more manipulation. But my biggest question is going to be, what does the dollar do this next year? Because we've had a dollar rally. We're sitting above 96 on the dollar index, Miles. And with at least 3 interest rate hikes coming within a few months from now, what does that do to the dollar? And inversely, what does that do to the metals?
Well, PPI at the highest rates ever. Did I hear that correctly?
Yeah, not only that, it's the acceleration. The acceleration
Right.
of that inflation is the fastest since the 1950s.
One on the flip side of that, your consumer index was at 5.3% this year. So PCE inflation is also high. So you've got producer price high, PCE high,
CPI at the highest since 82.
CPI at the
right?
highest since 82. But then you've got them standing on stage saying, no, inflation totally not a concern at all.
Well, they're finally starting to say that it is.
Well,
I
sorry,
think
yeah,
that
you're correct. They haven't been
they
saying
have to
it's
now
a
because
problem.
the mainstream media is saying that it is.
Right.
People are protesting in the streets because it is. They can no longer hide behind numbers. Well, guess what? They're going to try to hide behind numbers again. We know that the reported inflation that you guys just talked about, those numbers are a joke. That's understated. And now they just said that they're going to change the way they measure CPI again. Just like we had in the 70s and the 90s, when it gets inconvenient and politically sensitive, you just lie about the numbers.
Sure.
So they're going to do it again using 2019 and 2020 data. So they've already taken housing out. So now what else are they going to be taking out?
Well, and let's be real, Tori, on that fact. The Fed's most powerful tool since COVID hit has been jabbering. It's just been running their mouth. So while they're now verbally admitting that inflation is a problem and is persistent, their actions still continue to ignite inflation. So
Bingo.
we're, again, coming back to the more severe problem, and that is that the people are losing confidence in the Federal Reserve, which happens to be the most powerful entity in the world.
Well, and that's a scary proposition unless you own things like, say, cryptocurrencies or gold or land or something that's going to retain its value. So getting back to our show, just so we don't forget, so we don't forget what kind of show this actually is. We already do a political and economic podcast. Getting back to the flow of our show, this now brings up what I think is the most common question we get from listeners and clients, and that's, well, you guys talk about inflation all the time, so why didn't gold go up? Well, obviously it did today, but I think a better way to look at it is we know that inflation has been a major concern for a long time, especially, say, last year with the amount of money that came out with the spending packages because of the initial shock of COVID and what occurred due to that. What did gold do last year? Maybe it's not so much about what gold is not doing today on the day that you're looking at the market and you want to see what the reaction is going to be. But maybe gold was just a year ahead of the announcement. Gold made its move up last year from 1,400 to 2,100, almost 2,100, highest price in human history, on its way up to probably significantly higher prices. So is it unreasonable for it to take this very, very shallow correction over the last 12 months while the Fed and Jay Powell is finally willing to stand up on stage for the first time in a very long time today in December of 2021 and say, totally not worried about inflation except that privately we are? And he's finally willing to say that publicly. Maybe gold knew that 18 months ago.
Yeah. They're still so worried about it that they're going to change the way the CPI is reported starting next month.
Easiest way to get the numbers you want.
The easiest way to get the numbers you want. Well said. As we go to the silver chart here too, because the gold to silver ratios come up almost to 82 to 1. And so I'm going to ask you guys, because this is what the clients are asking, why is silver lagging? We'll get into platinum and palladium. The white metals in general have faltered more so than old reliable Mr. Stable Gold that tends to be far less volatile anyway. But Eric, starting with you, what are you seeing with silver?
We tell all of our clients, just based on what you said, obviously silver is the more volatile beast of the two. You have to know that going in, that gold is your ultimate safe haven hedge. Silver is going to do great, ideally, in times of inflation, but you have to weather these volatile storms. I personally, and I'm not a technician like Miles, so I can just go off of the fundamentals that we've seen. And silver seems to be in a tough spot for me. It is kind of disconnected for gold, so has been not moving up with gold, selling off when the market sells off, and also not moving up when the equities move up as well. So we've been talking for a good bit of time that we feel silver is going to break down to $19, about just below 20. I told Tori this morning, I feel like today's the day that's going to really propel that. We had the major reversal. So I'm really in no man's land with silver, and I kind of point to Miles on the charts. What do you see on a technical level as fundamentals seem to not be carrying much weight with the metals market?
Yeah, you're going to hate this because I actually think I'm going to answer it with a fundamental answer. So from a technical standpoint, silver's been in its declining wedge really since about May. And prior to that was just showing a sideways trading pattern. It's just the sideways trading pattern has been a massive range between 22 and 31. That's a 30% trading range. It's enormous. A $10 trading range in a, say, average $25 valued asset is enormous. And so you're right, it's the volatility in the silver market. And I think that the fundamental answer to the question is because silver is an industrial and a jewelry metal first and a currency second and a hedge second. And that's how most people look at it. Whereas gold tends to be the opposite. When people think of gold, they might think of jewelry, but they also think of Scrooge McDuck swimming around in a pool of gold coins. Gold in the mindset of every human throughout history has always been preservation, protection, and maybe even transactional. You know, there was a long time where we actually used gold as money. So I think that people sort of think that way. So when you have these massive overarching economic events taking place, like, say, a Fed announcement where we're starting to hint at life-changing type of events with interest rates and inflation, where it can affect a market for decades going forward. Like, say, what we saw happen with Greenspan and the 05, 6, 7 interest rate hikes, and what that led into in the real estate market, and what that led into in the stock market crash in 08, and the way that that 5-year period has set an entire generation going forward in a system of prolonged debt forever. So when you have these massive type of events that I think we all see coming over the next couple of years, people are thinking in those grander terms, and they just don't care about the industrial metals. They just want to go somewhere safe. And I think we're going to continue to see things like precious metals, specifically gold and Bitcoin, and other, if Janet Yellen allows Bitcoin to continue to exist. The one biggest legal retailer that was taking Bitcoin doesn't take it anymore. So Tesla dropped out of the Bitcoin world. They won't take it for payment anymore. So
just Dogecoin now.
Just Dogecoin. Just Elon coin. I'm sure they'll come up. Yeah. Just Facebook coin, whatever that's called.
The white metals too, I mean, acting industrially, you're seeing that across the board. Commodities are contracting, right? Gold and silver predicted in 2020 with the initial quantitative easing and throwing money at the issue. They predicted what was going to happen. They predicted the inflation. They both took off, and silver doubled gold's performance. It overshot. To me, it necessarily had to come down a little bit. And to be sitting at an 80-to-1 ratio is no big deal. It's a little high.
I think that the frustrating part, and I guess this is a question to both of you, is if we're going to classify it as this industrial commodity, it really lagged in 2021. Like you say, it jumped the gun in 2020, but we saw commodities rip and roar through 2021 like we hadn't seen before, all the while silver lagged with gold. So I think that's part of the frustration too. It's like, okay, it's not performing as this normal industrial commodity, and now we're not seeing the inflation hedge that we were told it was going to be. And so when clients are bringing that to us, how do we respond to that?
Because that's what silver does. And we've talked about that on this show a little bit. Gold and silver are money metals in the fact that they precede the commodities sector by 4 to 6 months. And that's what they did. And you can go back historically and see that. Well, they're going to precede them on the way down too, and they did. Starting in August of 2020, after they hit those highs, they were coming down while every other commodity just started to ramp up and go hit new highs. So we're seeing the same thing now. I think that you're going to see gold and silver lead the upward charge, that inflation will come back around. You'll start to see commodities stabilize and climb again, and inflation's not done because you're going to have things like wages having to match. So corporations already plan on record wages, and you haven't even seen things like geopolitical tensions. You do have kind of four primary things right now, potential crises unfolding, and one is Turkey's economy. It's completely sliding into turmoil, and their currency's lost 45% of its value with a lot of room to go. You've got the Russian invasion of Ukraine tension. You've got Chinese pressure on Taiwan, and then the potential collapse of Iran nuclear talks. Any of those things have an opportunity to shake up the world and produce wider conflict. So that's another reason that gold would do that. But if they stagnate the economy by raising rates too soon, you're going to see everything start to roll over. And gold and silver are no exception. If the stock market crashes, go back and look. You'll have a couple week incredible buying opportunity.
Well, and don't forget that dual purpose of things like gold or silver, too. I wasn't saying silver is an industrial metal and gold is a monetary metal. What I was saying is those are two of the very few metals that serve both purposes. Nobody buys tungsten as a monetary hedge. That's not something we do, or at least I hope you're not. Although I know there are people that are collecting old pennies. There's not a lot of money in that copper in them, so don't do that. But it's a dual purpose, and we're seeing both of those purposes play out. And when you have screaming high PPI on the producer side, and you've got increased PCE inflation on the consumer side, I don't see incomes going up in relation to that to where people are spending the same amount of money on the same amount of goods at higher prices. People are buying lower goods.
Not only higher prices, but higher interest rates.
Yeah,
they talk about driving the credit markets. It's going to slow down.
That all works its way through the entire economy.
Right. And that's where the stagflation
That's the economic slowdown. And it's December. December should be the highest employment month of the year.
Yeah. We'll see what that shakes
And
up.
market participation, employment participation is down.
And January and February should be two of the best metals months of the year, looking at historical
Well, there was
trends.
also retail numbers came out this morning. They've been completely silenced because they were kind of back burner to everything else. Retail numbers missed abysmally this morning, horribly. And, I had on some talking heads this morning, and everybody said, oh, that's just because everybody Christmas shopped early this year because of the supply chain.
Sure
It's just like, oh, okay, good.
Right.
But anyways, Miles, on that note, let's transition to the fully industrial metals. Let's go to platinum. First, as I told you earlier in the show, it's currently trading around $926. Where do you see that heading?
So if I lay the platinum chart over top of the silver chart, it's going to look pretty similar, right? I mean, they're both at the bottom ends of some trading ranges, looking to potentially push a little bit lower if possible, both silver and platinum. Silver, a breakdown for me would be great. I know it's going to hurt a lot of people's feelings, but I've been hoping for a silver decline for a long time. I know I'm the office curmudgeon when it comes to pricing, but that's because I want to buy more. And platinum, same thing. So I brought this up, I think, last week, but my favorite turnaround spot for platinum is the longer-term 618 fib. It was at a base that we put in back September, October, November of last year, down a little under $900, around $850, and that's where I'd like to see platinum find footing.
And on palladium, just really briefly, what we really like to watch at this firm is the ratio between platinum and palladium to where we can compound ounces. I can tell you in December of 2017, palladium for the first time caught up to platinum, and we had a 1-to-1 ratio. From that day on, palladium has been on fire, right? I think we got as high as 3-to-1, 3 ounces of palladium to equal 1 ounce of platinum.
That's right.
And now palladium has been falling like a rock. As we sit today, that ratio is at 0.54. So crazy that platinum is still at 920. As we alluded to with all of the industrial inflation, everything taking place, that's a good buy in the market right now.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, join us in the comments. If you got any questions, feel free to ask them. You can head on over to our website at McIlvaney.com if you're looking for some more info on your precious metals portfolio. You can also find us on Facebook at McIlvaney Financial or Twitter at ICA Gold. And as always, if you want to talk to one of us here at McIlvaney Financial to discuss your personal portfolio, you can reach us at 1-800-525-9556.
Thanks for listening. Have a great week.